for renewable energy, clean infrastructure, water, and waste. I'm responsible for the fundraising and investor relations at Meteor.
Thank you very much. And then Paul, lastly.
Alternative investments. We run 4 different strategies with about $5 billion under management across them. We have a Pan-African infrastructure franchise under the brand name AIM, African Infrastructure Investment Managers, which is the largest strategy with offices in 5 different countries. Then we have a sub-Saharan private equity strategy, growth capital and buyout. And we have an impact strategy, which is also Southern African, which is focused on education and affordable housing. And finally, we have a fund-to-fund program as well. Thanks, Aline.
Thank you very much. So I think when I started speaking to you guys for preparation for this, I was chatting to JP and I was saying to him, in my mind, there's a couple of things we need to discuss, and they were mostly COVID-19 related. And then JP, in his normal, extremely kind and polite way, pointed out that that's not the only thing that's happening in fundraising, and that there is certain long-term trends that we need to discuss. And so I think I do want to sort of divide the discussion up into talking about some of the short-term impacts and some of the short-term issues, but also to talk a bit about the more long-term and more medium-term outlooks and trends that are available. I think if we can start by maybe just everybody giving me an idea of what has the experience been in the last couple of weeks. I know that AFCA put out a survey where they asked GPs what the impact has been of COVID on their fundraising, and the GPs indicated that about 50% of them thought it would take longer to raise the funds than they originally did. About 16%, I think, experienced that an LP ceased due diligence or pulled out of a close for a fund under the current circumstances. And I know that experiences has been quite mixed, and it would be nice to just hear from everybody on the ground what have you been experiencing. Albert? Albert, I'll start with you.
Sorry, I was on mute. Sorry. Thanks a lot, Helen. Look, I think, we announced in Q1 2020 our close of our third fund, where we exceeded our target of 250 million, and we exceeded to 286 million, as you know, Helen. But in reality, we had to close that fund end of last year. So we, you always have like a couple of months delay for announcing that. But the reality, the fund was closed. And to be honest with you, we were lucky because I think people in the middle of the fundraising is delaying everything. And I think you have to differentiate between 2 types of categories: the first-time fund managers, and then the well-established fund managers, which it's a different perspective for both of them. I think for first-time funds, I think it's going to be very, very difficult for them, because what you're trying to do, you're trying to build trust with your investors, and the trust with investors is very hard to build that through a video call, so as you can imagine, you all know. I think for established fund managers, I think it's different, because it is more related about your strategy, about your team. And I think you are in a position already that you have built that trust with your existing investors, So I think you have to differentiate both. But definitely for the short term, I think has been hit very hard, this COVID-19. Having said that, Helen, I think we have another big effect that happened to us with the Abrash situation that happened to us over the last year or so, a couple of years now. I think that has had a bigger impact across the board to all the fundraising, and that to me has a much profound impact in the fundraising environment that these 3 to 4 months on the COVID-19.
Thanks for that, Albert. Maybe if I can, John, I'm going to get back to you, but JP, just on that subject, I know that one of the things that the guys also did say, and which is maybe more applicable to established fund managers, is that they have an expectation that exits will be delayed as a result of what we're looking at COVID. And we do know that there is normally expectation as you fundraise to have exited a certain amount of investments before you can go into another round of investments. Just wanted to ask about your experience and how you're seeing it and how you're seeing that develop.
Sure, we've definitely seen that materialize for ourselves, where we have we had exits lined up that obviously have moved to the complete back burner in COVID-19. which does then hamper your ability to return a certain amount of capital to your existing LPs, and in that way give them confidence to re-up into a successor fund. So it definitely is going to mean longer holding periods, and that's going to put performance on an IRR basis under pressure, which I think then, to your earlier point when we had the offline discussion, it begins to make some structural changes into the industry a likelihood, such as the catch up in the carry waterfall. I think that's going to come under pressure over time as the split of alpha between a GP and an LP in an underperforming fund is not going to be ideally balanced in the view of some LPs going forward.
John, maybe then just to catch up on one other thing that Albert had said as well, is he'd spoken about first-time fund managers. And if one looks at Africa's data in 2019, a quarter of all fund closes in sub-Saharan Africa were by first-time fund managers. And I know that you do work with a number of these funds, and I was just wondering, in terms of your clients, how are they experiencing it? Is there a difference between first-time fund managers and more established? Is there a difference between guys that are raising primarily from the DFIs versus more commercial capital? How is the experience going?
Yeah, so I think firstly, there's definitely a difference between the DFI and the commercial LPs at the moment. I think perhaps the DFIs are in it for the long term, and this is their mandate. So, they perhaps are more prepared to ride out the crisis. I also think that particularly in the South African market, we're seeing a big push by a lot of the traditional pension fund LPs to actually support first-time black fund managers, emerging black fund managers. And a lot of the work that we are doing is in that space. And again, I don't see that slowing down or stopping. I think there's a bigger imperative than just kind of raising funds that is at play there. I think we've seen, aware of one fund that has actually stopped and fallen apart, but we've got a couple of funds that are heading for second close at the moment. We are seeing people like the SME fund, which is investing into venture capital, continuing to invest and put money into that ecosystem and actually raise more money for themselves. So, yes, there's still fundraising activity. Is it at the level that we would expect? Probably not. I think we are also starting to see, kind of COVID-19 funds coming out. You'll have seen the announcement by Ethos and 91, and I think Sanlam was the other one. So I think, people are responding to the market opportunity that is seen to exist. So I think there'll always be money for the right opportunity, and I think COVID is throwing up opportunities, and it's a question of how quickly the fund managers can respond to those.
Thank you, John. Paul, maybe just to pick up a point which Albert had also mentioned, which is arbitrage. And I think in general, an event like COVID is a bit like the global financial crisis, and it causes an initial sell-off or a risk-off type of position, which we've definitely seen in the last couple of months. But off the back of that, we've seen massive QE in most of the developed markets. And there's some uncertainty how these two factors together might possibly impact fundraising in African private equity or even South African private equity. From your point of view, you guys are looking at it across different asset classes and across different more specialized mandates. How are you guys experiencing it, and what is your view on this going forward?
Yeah, Helena, I think, global easing is going to trickle down into emerging markets, including Africa, over time. So more liquidity available will eventually arrive on our doorstep, as it did after the 2009 financial crisis. I think the other thought, by the way, is that in emerging market currencies, and we've seen this already to some extent, which have been hit in the crisis, will recover. And I think, over the next 18 months, we'll see the Rand a lot stronger than we possibly imagined it might be, for instance, as a case in point, just because of this, this risk on trade, which will happen, globally. On the issue, I think, just to endorse what John has said, what happens in a dislocation like we've had is that there are areas of trouble, and we've seen this, by the way, in our own portfolio. And then there are also areas of clear opportunity and areas where, you're sitting in very defensive spaces. So, for instance, we've got some assets involved in the agri space, for instance, agriculture. I didn't mention agriculture. It's a business in which we have a minority interest, UFF. But agriculture has traded through this very well. In fact, if you look at South African farming enterprises, for instance, which are exporting fruit crops into Europe, they've had a bumper year. It's been a great agricultural season. The rand has played to their position, and obviously right through lockdown, the one element of the economy that was kept going, and this is globally, obviously not just in South Africa, is agriculture. Elsewhere we've seen spaces like renewable energy, for instance, where you've got an underwritten offtake, and electricity consumption is still robust. Those kind of assets. But contrasting against that, you've got businesses exposed to real estate or to the private sector consumer that have gone through extraordinarily traumatic times, and have had to really work hard to try and create a sustainable future for themselves. So I think, and then on the look forward basis, where is capital deployed today going to yield the best returns over the next 5 to 10 years? Obviously, a very important question for all investors and fund managers.
And maybe to pick up on that, Paul, and on something else that John was also saying, is we've seen quite a lot of activity in the sort of the debt space. So, I mean, most of the companies within portfolios are if you're on the agriculture space, obviously not, but as you move towards more being directly exposed to the actual crisis, you most probably going to need some cash to bridge. And everybody at the moment is looking for that cash to bridge. And the banks is being flooded with a certain amount of liquidity, still not necessarily in a position to cover all of that. And I know, John, that's one of the things that you've spoken about, is there might well be an opportunity in that space. We've seen some of the players looking at, partially at their own portfolio companies and being able to fund those portfolio companies with debt. And then we've been looking at, which I think Ethos is sort of somewhere in between. They're looking to fund their own, plus Investec, the link up, and then partially to look at other businesses as well, where Sanlam's, I think, is almost more of a pure debt play, in where they are looking, in essence, to step into the space which has been vacated by the bank, because the banks, in essence, are on triage. They have a choice of businesses to save, and they can, in essence, choose to save the lowest risk ones, which doesn't necessarily mean the other ones are non-viable. But it does come off the back of a trend for us, and I think that's what we were talking about, is there is long-term trends in that mezzanine debt and debt provision was a theme before all of this started. And so I want to ask a couple of questions after that very long intro. The first is, Albert, for you and for JP, do you guys see an opportunity for that? And for yourself, Paul, as well? And then, John, just the question that I have for you is, in terms of, if you have a fund which is structured like the normal structure that we used to, but you might need to go and find some debt funding at this point to insert, what does that mean? Do you need to start an additional fund? Can you adjust mandates? What do you see as the options for this available? Albert, if we can start with you.
Yes, absolutely. Thank you, Helen. Look, I think, to be honest with you, I have a different view of how the banking system has, acted after the COVID-19. I have seen things I have never seen before. I think the banks have been extremely flexible, very supportive of the good business, at least to our portfolio. We had like 6 months grace period in some of the banks in Ivory Coast, some of the banks from Senegal, some of the banks from Morocco, from Egypt has been very good. So I have seen a very positive reaction to the entire banking system. Things that today has happened to our portfolio 5 months ago were impossible. So I think that's the way I have seen it. And also I see that mezzanine I have been getting so many calls from a lot of debt funds and mezzanine funds. Everybody is out there looking for the opportunities, I think the big difference as a fund manager, it depends if you have dry powder or if you don't. So that is the huge difference. If you don't have dry powder, then or you go back to your investors and ask for for an increase of capital of 10, 15, 20% to cope with these liquidity issues, or you have to go to this debt situation. Let's face it, when you're an equity investor, when you are going to a mezzanine or debt fund to help you out through the crisis, that's an expensive solution. It is a very expensive solution. Today, we haven't had the need for that, and the banks have been extremely supportive of our assets. It is true that also our assets had a very strong balance sheet, so that help a lot. And also, we did have in our portfolio, which one of the things that has been told to all of us, this COVID-19 has been that diversification is one of the most important things that we all have done. Because as Paul was saying before, we have assets that have been growing at 50%, like retail and supermarket, and I have assets that have gone to zero, like retail of fashion clothes, you know. So I have the both spectrums, and the average actually is not that bad. So that has been my view. I think we are lucky that we're going to need the debt or mezzanine fund structures today, as we're coping with the liquidity crisis, mainly putting a lot of work on operational aspects, like managing the working capital, the account receivable, the accounts payable, the inventory turns, the supply chain turns, all of those things. And I think that mitigate a lot of the liquidity needs. But to me, I think going forward, which that probably your question was referring more to that, Helen, I think it's going to be opportunities in all aspects. I think it's going to be opportunities for equity investors. I think it's going to be opportunities for debt investors. And the good thing that we're facing now in the market is that this has been like a natural filter of good, resilient companies. So whoever has survived COVID-19, you know that it's a good company to invest. And I think that's probably the good positive thing that we're seeing. And at the end of the day, look, all of us that we had equity, they still have dry powder. Of course, in our third fund, we still have a big amount of dry powder to deploy. And we have slowed down the investments. We're letting come slowly, and we're seeing what's out there in the market. All of this, that everybody thinks there's going to be a big opportunity on better valuations, I have not seen it yet. People are still having their minds, you know, their valuations, because you know, the comparables have gone down in the first quarter, but they have gone up in the second quarter. You guys know better than us how that happened. So I think everybody's going back to the same valuation that we had before. So that is the way I see it, Helen.
John, I want to hold you in reserve, but I mean, if we can get back to you, JP, if you want to go next, yes, if you don't mind.
Sure, I'll be very brief. I'll definitely want to echo what Albert has said. We've definitely seen the banks across South Africa, Uganda, Kenya, where we've got direct exposures, being very accommodating. We've seen a number of the DFIs that are in our portfolios trying to assist as well via business support or some type of facility arrangements as well. We've also tried to keep as much powder dry in terms of protecting for follow-ons in a preserve and protect type of manner. There definitely is an opportunity, but as Albert says, that comes at a hefty cost. And what we have seen in our current fundraising, dealing with new investors to ourselves, they've definitely clammed up, but are starting to enter back into risk-adjusted type of strategies. So looking for downside protection as a starting point, which obviously makes mezzanine an attractive entry point for them for now. But hopefully that comes back into vanilla equity type of commitments going forward.
Paul, from your side, looking to raise a debt fund?
Sorry, it's just taking a minute to go off mute there. Yeah, look, we do have debt product in the house as a whole, and I do think that mezzanine is an interesting space. But I do echo the points about the banks that actually in this crisis, as opposed to the 2009 crisis, the banks have been very flexible. And I think in 2009, the US Fed and others, wrote cash to the banks at zero, and the banks took the whole margin themselves. And there was a massive transfer effectively from the US taxpayer, in fact, in favor of the US banking system and elsewhere in the world. And I think this time around, that's not happening. So that's a good thing, by the way. I mean, not that the banks didn't need help at the time. They did. They clearly did. JP Morgan, I think, went below $30 a share at the time. It's now close on 100, and went through that recently. But I think we are seeing the support traveling into the spaces where it's needed more on this occasion. That's what's very important about fiscal support, that it actually ends up supporting the right entities ultimately, which is in everyone's best interests, if those who really need support are assisted through this process, rather than, there's some kind of, windfall for folk who don't truly need it.
Thanks. And then, John, as of the subject of dry powder, JP and Albert were pointing out that, it depended so much on where you were in the cycle. So saying that you unfortunately on the wrong spot of the cycle, what can you do? What do you think are the options structuring wise?
Yeah, look, I mean, if you don't have any money, there's not much you can do other than go to a third party or try and get money from your LPs, either in a sort of second fund or, alongside by way of additional co-investment. I think if you do have dry powder, then you've got flexibility, because normally within the average equity fund mandate, you can invest in MES in your own portfolio companies. And every deal that you do is largely a junior loan or a MES loan of some form with equity at nominal value. So putting more money into existing portfolio companies is a possibility. Clearly, they have to meet an IC test. You're not going to throw good money after bad. What you may need to do is you may need to speak to your LPs about increasing the percentage available for follow-ons, because you're going to need that in this case. And you may also need to speak to them about moving the prudential limits. You might need to put more money into a few of your portfolio companies and write off others so that your diversification gets reduced, but at least you've been able to take those emergency steps. And also, I think because a lot of those portfolio companies that are successful are likely to be in the market for bolt-on acquisitions. So, it's not only the distressed portfolio companies that provide the opportunity here, it's those that are already performing and well and have the capacity and the desire to get a good asset while it's out there. I mean, I've got clients who, in the South African space are looking to buy tourism assets now because they can get them for nothing. And you'd think that that would be the last sector where you'd expect business activity, but in fact, opportunistic people are looking to fill the gap.
Then maybe on the subject of risk protection, and that you did mention, I think, JP, you mentioned about downside risk protection. I mean, one of the themes which is starting to stand out quite strongly and has been growing for the last couple of years is the blended finance theme, if we want to call it that, in terms of how we structure products and how the DFIs participate within products, and how to get to the point where private capital participation ratios go up, that there's a crowding in effect when we talk about investing DFI capital. I mean, what I'd really like to ask is whether you see that for the fund managers, whether you see that the structure in your products that you're planning and looking at changing going forward, considering that trend and being able to implement that trend on a more, call it a more leveraged basis. And then, John, maybe from your side, whether you're seeing any structuring coming through that does reflect that, or whether there is still some slow uptake for it. Go forward. Paul, maybe you'll start on the other side for a change. Otherwise, you're always at the end and everybody said everything. So we'll start on that side.
Sorry, Aline, just trying to get the mute button off here. Yeah, look, on the blended finance theme, I think there's a lot of opportunity in that space. And I mean, certainly we've been having a number of conversations with funders along those lines. And I think that, depending on what you're trying to achieve as an investor through deploying capital in Africa, I think the blended finance route definitely offers a lot of, opportunity to leverage outcomes. I mean, maybe just to comment briefly on some of the stuff we're doing in that space. For instance, we've launched an affordable housing fund, which is looking to make accommodation available to households earning circa 20,000 Rand a month or less. And it's what we call gap housing, because government is making houses available at a price point of 450,000 a unit a list basis. So in other words, if you put your name on the list, eventually you will come up on the list and government will provide you with a house. But above that level, and to the level where banks are prepared to provide mortgage financing, there's a kind of gap in the market where it's actually very difficult for a family in that situation to secure a home ownership. So we've put together a fund that is looking to create an outcome in that regard. And so we've stapled a financial return objective in that fund, very much alongside a social return objective. And certainly I think that kind of impact fund is going to become a lot more prevalent. We're seeing a lot of interest in that space from not only DFI type investors, but also mainstream investors who are looking at, how do they meet, sort of sustainability objectives that they have as a fund as a whole, in a way that defends fund capital and provides beneficiaries with an adequate investment return, but at the same time is contributing to growing the economic fabric of the country in a kind of robust way. We've also, in that same similar line, launched an affordable schooling fund, and also in the climate space, we've got a funding product out there which is partially underwritten. So it's not quite, it's sort of blended finance, but it's through an underwritten structure rather than a capital, in the actual capital construct of the fund. So maybe just some thoughts there on that space.
Thank you, JP. And from your point of view, are you seeing a blended finance and maybe, as Paul points out, impact-driven funds as much of a theme from your side?
Sure, we definitely have, and we've invested in those spaces in student accommodation on a similar type of thesis that Paul talks to in the past, and obviously have got a large remit around a fund that we had a first close of in December of last year, and are looking to get to above $150 million before the end of this year in the renewable energy and clean infrastructure space, which was previously a concessional or some type of impact domain exclusively up until a couple of years ago. And now, because the low cost emission and ease of deployment, the parity has been met in relation to coal-fired power stations. So there's definitely a lot of scope for that in Africa. I think the DFIs have obviously led that charge. And I think you'd argue that you spoke to most GPs, they would say, well, an element of what we do anyway involves not strictly blended finance, but has got a big impact imperative built into it. And I think that's one of the key differentiators of our market on the African continent compared to other emerging markets, which we should leverage in terms of an attractiveness to LPs and continue to drive that going forward.
Albert, from your point of view, are you guys looking at your next round of structuring and your next round of products? Are you looking to leverage off the blended finance model and maybe adjust the model on which your fund is based a bit? And do you see that as an ongoing trend? And maybe impact first products, any of that in your space?
Look, I think Paul and GP, they were spot on terms of how the market is looking at these two different trends. I think the blended finance is already there. When we structure our investments, we do a combination of equity, quasi-equity, shareholders loan, convertible bonds with a coupon at the end. I mean, you get as much creative as you can, because at the end of the day, the local banking system is not prepared or equipped to give us more leverage. The reason why we don't put more leverage in our structure is because the banking system doesn't give us loans for that. But as a fund, we absolutely look at that in order to diversify the risk, of course. I think that's the first comment. And having said that as well, today you do have a lot of co-investment activity. And I think we're geared more on having co-investors helping us to be able to cope with larger transactions and therefore mitigate the risk and be able to deliver better returns, as co-investors have normally a lower fees and carried as well. That's from that side. In terms of the impact, I think we have to be careful, because by definition, any fund in Africa is an impact fund. We are just investing, and we have an incredible social impact across the board, as well as you know, the market is dominated by DFI's money. Therefore, that is imposed in through their processes and in through your investment process to ensure that is that embedded into the decision-making process. So, having said that, you need to be careful how do you market it, because as soon as you call yourself an impact fund, everybody thinks that you are going to be delivering lower returns. So then that's a different type of investor nowadays that unfortunately is still there. I think the way that we have seen it ourselves, like, yes, we're an impact fund, but we're not looking at just impact as such. I mean, there's a lot of things that they are required to do. And I think Paul has hit the nail on the head on the two aspects which are critical, as we know, in our continent, in the African continent. Therefore, I think you have to make sure that you have your strategy, you have your diversified strategy, that you explain the impact that you do have, and then you to gear yourself to depending on your investor base. You know, I think that's probably to me the big recommendation that I would say on that regards.
Thanks, John. And I mean, from you guys, you're seeing basically the next wave of funds. You guys are seeing what funds are going to look like in 2 years' time and 3 years' time. So if you look at it, are you seeing the DFIs participating in a different way? Maybe, first loss tranches, guarantees, risk enhancement structures, rather than clean commercial participation at this point?
We're definitely starting to see first loss capital come into the funds. The question is always who is the beneficiary of the first loss. I think there's a real desire to try and attract more commercially minded LPs into the African private equity space, and I think that's important. I think there's generally a lot of debate in Africa about what the right time period is to keep your fund open for, and whether we should be looking for more permanent capital vehicles or longer term capital. And that model continues to evolve. So a lot of the work we do provides for inflection points in funds where you can decide to move from the fund model into either a longer dated model or even a listed model if the LPs agree. That comes with the need to provide liquidity mechanisms for those LPs that actually don't want to move into the longer term environment. So there's lots of ways to be creative at the moment around structuring appropriate funds. And then I think on the kind of mandate and the blended finance side, I absolutely agree that you can do that within existing funds. But I think there are fund managers out there that are starting to say that if you had a fund that could do either equity or just pure mezz, so with a much broader mandate, that you would be able to unlock a much broader range of business opportunities in your fund, particularly around family businesses where the guys want the capital, but they don't want the dilution that comes with the equity. So I think people are starting to think more carefully about, do I have a mezz fund and an equity fund, or do I have a fund that actually is able to access both sets of opportunities? And then I would absolutely agree that any investment in Africa makes an impact. But I think the DFIs in particular have driven managers to become very conscious about ESG and changing the behavior of the portfolio companies that they invest in, coming up with action plans to remedy. It's generally a positive story, I think. And I think the debate going forward is Abraj has been bad, but, private equity has been a real force for good on the African continent. In the South African context, of course, over and above the kind of normal ESG, we see the push to actually invest and increase black ownership in underlying companies, and some of the investors like the PIC make that part of their measurement criteria of the management. So there's this real theme of private equity for social good.
Then there was another trend, John, that you mentioned that I would like to get views on from everyone is you mentioned the SASME fund, which is looking at a VC funder fund at the moment. And it's an interesting trend for a couple of reasons. Part of any rebuild process is there is going to be a lot of small businesses that may not survive this current situation. And I know that I am mixing two themes, which, there's a question whether it should be mixed, which is SMEs and VC. But, you know, the other part of the trend which we have seen is that the number of VC transactions in South Africa has exploded over the last 3 years. You know, there's suddenly a ecosystem where there wasn't necessarily possibly a supportable one before. It was difficult to look at it, you know, as a supportable asset class in the past. Where in the last 3 years, there definitely has been a significant uptick. And though the data out of Africa is not quite as it's not gathered in the same format, there does seem to be a similar tick up, especially if you look at Egypt. They've got a very specific and a very vibrant VC environment, and there's all across the continents, there's hubs where there's quite a lot of VC happening. And I think maybe for the fund managers, if we can have a view on SMEs and VC, Albert, I think you specifically have quite a bit to say on this space. But then also for the rest of you, do you see an opportunity here? And if you do, you know, is it only risk enhanced? Is it, you know, is it a specific spot within it? How are you seeing the opportunity on the smaller end of the scale, both for SMEs and for the venture capital side of it?
Yes, absolutely, Helen here. I think it's a huge gap in the market today in the first two areas of financing any business, being the business angels community and being the venture capital side of the business. That is a huge gap in the market today, across the board into all countries, I have to say. The diaspora of those economies still have a huge lack and gap. We are seeing opportunities from our portfolio company. And that's where we have been focusing quite a lot. You know, for example, we do have a great asset in our third fund called a company called Cofina, which is basically a company operating across the West Africa and Central Africa in Ivory Coast, which has a headquarters, Senegal, Cameroon, Mali, even Burkina Faso, Congo, Togo. We are servicing more than 250,000 small and medium enterprises, very small and medium enterprises, that they need money. They need the working capital needs that today the banking system is not equipped to provide that with them. And we are seeing that they are very valid, solid businessmen, sometimes 2 or 3 guys business that are starting and with very sound, profound business plans and ideas. And I think there's a huge opportunity of that regards. Having said that, it is as well true that, as you know, in the argot of in the lingo of the venture capital and private equity, we call that part of the life of a company, the death valley, because 80% of the companies normally die through the trying hard to get through the break even, because or they end up without cash, or they end up with other problems of management, which is a big difference between the idea and the execution of the idea, et cetera, and so on. So we believe that this is still a huge gap. It's also true that the DFI community has been very active on pushing some managers to go into that space, and we have some success stories from that, but still the gap remains immense in my view.
JP, any interest from you guys in that space? And if so, would it need to be, would there need to be some blended finance involved, or how do you think it could possibly be made to work?
Sure. So for us, the technology part, so the pure venture capital side, a remit that we wouldn't get involved in. Those businesses that scale fast have got a big technology risk and uptake. It's not our remit. But definitely on the SME side, where we touch that the most is in our consolidation or platform roll-up strategies, where we would have a business in the FMCG space or in the pharmaceutical space, as we currently do, that it becomes a catalyst to acquire additional businesses and build scale through a platform or consolidation roll-up play. When you are then acquiring businesses that wouldn't fit the mandate of a fund that has to make a commitment size of $15 million to a portfolio company. So through the portfolio company, you're able to drive a lot of that growth. And we've successfully done it a number of times where businesses have acquired, up to 20 SMEs along their growth trajectory to an ultimate exit. So that's the closest we come to it directly from growth capital side. A little bit of a deviation would be we do take a little bit of risk in project development for renewable energy and clean infrastructure projects, where somebody that would find the farm, do all the permissioning, do all the various studies, and then start to implement some type of build of a PV plant or a concentrated solar power plant. So that's the only other touch point that we've got with nascent or startup types of businesses. But yes, I agree with Albert that there's a massive need, and it's really gratifying to see how that is starting to come to fruition, not only in Egypt and South Africa, as you've mentioned, but in Uganda and Kenya, etc., that have also got big technology and SME hubs.
And Paul, from possibly quite a large asset manager, how are you guys viewing this? A space that you should be in, space you shouldn't be in? What are your thoughts?
Okay, so I think there's definitely an opportunity set in these areas. One of the things that we've been very focused on is, playing in the space where we have a deep skill set, and where we don't have a deep skill set, be very cautious. Just to JP's comments, I mean, we have been involved in quite small startup type investment situations. For instance, we have an investment in African Clean Energy Developments, which is a renewable energy development business, which has done a lot of developments, both on account of funds that we're invested in, but also more broadly. We also, in our education fund, for instance, we are grassrooting essentially. I mean, we're partnering with businesses that have 2 or 3 schools. They're very small to begin with, and we're trying to grow them to 10 schools. So we have been involved in the smaller space. But when you look at VC, where you are committing capital to an idea, to tech, to pharma development, that kind of space, it's in our sense a specialist skill set. And I do think we need more of it on the African continent, but I think it needs to be done by very focused teams who have deep skills in that space. And then maybe a last comment. By the way, I think on the SMME side, development of that area for the continent is critical, because that's where employment will take place in these types of businesses. And Old Mutual as a business has committed a really sizable chunk of capital at the time of demutualization. They took all the unclaimed shares that arose from 4 odd million policyholders who were allocated capital in the company at the time of listing, and created a chunk of capital. And a huge part of what that foundation does is in developing small businesses, so making capital available on a commercial basis. May not risk assessed, but they're trying to create commercial outcomes to develop the SMME sector. So I think it is critical. I think the last point, is that the VC space in South Africa has benefited hugely from the tax dispensation that was created by the Section 12J permissions in the Tax Act, which have allowed investors who make allocations into qualifying venture capital, in terms of quotation marks. If you qualify under the venture capital definition, then the investor will get a tax deduction subject to certain limitations for making an investment into those businesses. And I think that's been hugely beneficial in terms of driving capital into those businesses. And I think it really has helped in terms of getting the VC space, much more momentum in the South African context. And I think it's something that, should be considered more broadly across Africa. And if you look, I think even in the UK, for instance, I think, tax concessional funding arrangements is also what mobilized a lot of capital into that space in the UK. I think it does require, government leaning in to get these things to happen.
On the subject of tax, we've had a question come through where Cedric is asking about the choice of jurisdiction and investors' preferences. And he's mentioning the Cayman's blacklisting by the OECD as a consequence of compliance. John, we most probably need to start with you here. If you can maybe give us a view of what is, if I'm starting to fundraise for a fund in Africa, what are my considerations? But where do you think I'm most likely to end up, and why? And maybe, yes, to just talk around the Cayman issue and what happened and why.
Yeah, look, I think that traditionally Mauritius has been the jurisdiction of choice for funds going into Africa. Recently, it looks like they're going to go onto a sort of blacklist. So they've got until the 1st of October to kind of solve that problem. They've always solved their problems in the past. I'm fairly optimistic that they'll solve this one, but if they don't, I think we do have a real question in terms of DFI investment into African funds. I think a lot of jurisdictions, if you have a fund that is just bespoke for that jurisdiction, then by all means set your vehicle up in that jurisdiction. So if you're doing a South African fund and you simply have a South African mandate, there's no reason why you shouldn't just create a South African partnership. It's where you have a fund with a kind of multiple jurisdiction geography mandate that the issue becomes more important. There are very few funds for Africa, in my experience, that use Cayman. I've migrated one or two out of Cayman in my time. I think we are starting to see Luxembourg come onto the radar for particularly European investors, European DFIs. It is more expensive, but I think that's possibly a trend. But I can't say that there's a definite move one way or the other. There are funds that use Guernsey, there are funds that use Delaware, there are funds that use Cayman, there are funds that use BVI. It all depends on the tax profile of your investors. It depends to some extent on your investor preference. So if you have an investor who's prepared to write you a big check, but who says to you, listen, I want to be in Cayman because that's what I know and love, then you'll probably create a Cayman feeder vehicle or a Cayman parallel vehicle for that guy to invest through. So it's driven by economics as much as anything else. Prior to the Mauritian blacklisting, we were seeing people like EIB refusing to invest in fund structures where there was a global business license company. That hasn't really been a problem for Mauritius because even if you're a fully taxable Mauritian company, there is no capital gains tax in Mauritius. So 90% of your fund returns are not taxable anyway. And there's also no withholding tax. Well, there's no tax on dividends received and there's no withholding tax on dividends going out. So unless you're structuring a lot of your investments in the form of interest-bearing loans, you can probably still use Mauritius, a fully taxable Mauritian structure with some degree of success in your fund planning. Other than that, I've done a fund in Namibia recently. I'm trying to do a fund in Kenya. Kenya is a bit more difficult because they don't have a limited partnership concept, and we have to work with what they call a limited liability partnership. So we're kind of feeling our way a bit there. But it depends on your geography, and it depends to some extent on your investor base. And you've got to be flexible and look at the check size and see what the art of the possible is.
Thanks, John. So we are getting towards the end. I just want to make...
Can I maybe just weigh in quickly on that one, because it is a little bit of a hobby horse of mine. And maybe John's views on this would also be interesting. But, to me, it's quite sad that if you look at the listed market in South Africa, I think a huge chunk of it was relocated to London, many years back, because, the trading ecosystem around listed shares, sort of sits in London kind of thing. And so some of our big counters moved abroad. And I do think that the private equity industry has a huge opportunity to be domiciled in Africa. And I think Johannesburg makes huge sense in that regard. And it would be a tragedy for me if, Africa Private Equity Inc. is actually, going to be ultimately domiciled in Mauritius I could live with, but in London. And I think, the domicile for this kind of activity set requires, deep legal skills, strong legal jurisdictions so that people can rely on the rule of law, and flexible tax dispensation that makes it not unattractive for investors to come in through that portal, as it were. And I do think South Africa has partially solved for this because, historically, we've always had to have the dual fund structure where, foreign investors had to come in through a parallel structure because the South African entry point was so severely prejudicial that they had to avoid it. The legislation has been changed so that if you're investing in a South Africa fund, then coming into a South Africa domicile structure is no longer as onerous as it used to be. So foreign investors can come in through a locally domiciled structure. But I do think South Africa as a jurisdiction should be trying to frame its, trying to create the legislative environment that makes it an attractive destination for any fund to set up that has an Africa context to it. Because, we have everything other than the jurisdictional framework to make it work. We got exceptionally strong legal skills. We got a strong banking system, financial sector. The rule of law is quite robust here. I think it really is, a space we should be trying to mobilize around as a continent to try and own this kind of ecosystem, on the continent. Sorry, Helene, that was my little pitch for the.
No, it's a fair point. It's always been, it's always been an opportunity we've missed as a South African economy. Just as I say, if I can get a wrap, I see that commenting types, so I might just come back to them. But what I wouldn't mind if you guys just where you see your prospects, where people see prospects in terms of fundraising. But if you could also, the one thing we haven't spoken about, which I do think is relevant, there seems to be a drift towards more specialist mandates. And I know, John, you spoke a bit about the equity versus MES, which may be actually going the opposite direction. But if one looks at what got closed last year, then a very large amount of that was infrastructure, actually. It wasn't really PE. We see it as part of the PE landscape, but it was mostly infrastructure and specifically focused on that. And we've seen a couple of other also sector-related funds, so there might be a drift towards that. So if I can maybe just ask you to include that in your comments, and then I will just catch these comments and get and wrap up with that. Thanks, Albert. If you want to start.
Yeah, absolutely. Can you guys hear me? Yes. Can you hear me? Okay. I think the way I see it is that we are in the right place. We're seeing a short-term turbulence because of the COVID-19 as a global crisis, but we still have a long-term prospect of growth in our economies. I have been listening to many worldwide asset managers, and they're looking at all the different asset classes. And there are like 4 trends that everybody agrees, from JP Morgan to UBS to the large investment firms. And they're saying that the big 4 trends that will continue, and they all agree, one being anything related to aging population, 2, anything related to new technologies, we're going to be seeing more and more of that. And the 3rd and 4th is that emerging markets will continue to be the growth of the world. And that everybody agrees. You see that in the top 500 companies today, more than 70% of the profits comes from emerging markets. And the 4th one is the rise of the middle class is going to be the engine of growth for the next 2 decades. All of that linked by the fact that the Feds and as well as the European Central Bank has make moves of unprecedented scale on low interest rates. I think we're going to have for the next decade or 2 a macro environment that will have a very low interest rates base that will be force investors to look for the alpha, as GP was discussing before. And I think private equity is one of those assets that can provide that alpha to the all the returns. Having said that, I think Africa has a long-term issue that we need to solve. One being not having enough track record on returns across the board, and that is to the expand private equity, Eastern Europe private equity, and definitely European, US private equity, particularly in the leverage buyouts, that there's going to be a lot of opportunities. And also the fact that we do have a lot of funds with a lot of tailgating, what we call it, which is basically, it takes longer than 10 years to close your fund because there's one thing happening in one of the sectors or one of the countries. And I think those are the 2 issues that we face as an industry that we have to try to help each other as much as possible to overcome it. But definitely anyone that is in the fundraising, I think your quarterly report, it is probably your best marketing pitch, that you show your investors the quality of your assets, the quality of the information, the valuations. Being a very strong valuation methodology is very relevant. And all of that compiled, I think we still have, of course, it will be delayed, as we have said at the beginning, but we're here for the long run and for the long term. And I think Africa is the right place to be.
John, you?
Yeah, I think I'll definitely agree that Africa is the right place to be. I think we're seeing the African private equity market generally maturing. I think South Africa is quite mature, but the rest of Africa is catching up. And yes, there are sectors. I think big top of the market funds are difficult at the moment. Mid-market makes a lot more sense. And then We all know the sectors that play to the middle class, that play to education. I think healthcare coming out of COVID is going to be a focus. Infrastructure, there's always money for infrastructure. Food/agri, I think that's kind of where we're seeing, and affordable housing, we're seeing quite a lot of money for that. Don't see that changing. And the one thing I would say in response to Paul is that South Africa is open for business. The problem has not been tax, the problem has been exchange control, and has been the general South African political story. That's getting better, obviously, than it was during the last years. But there's still a sort of marketing issue to do on South Africa. But yes, we can definitely do South African funds.
Sorry about
thanks,
that,
John,
JP.
and thanks for your comments on the areas that make sense to invest in.
JP.
Sure. I think it's all been said. There's definitely a certain amount of development that's happening in our industry because of the specialization that you're seeing in certain niche types of funds. And then just a little bit on a lighter note and anecdotally, given COVID-19, it's really nice to be able to speak to investors and say to them, you can't use the excuse that the next time I'm in London, we'll entertain a meeting. So we've seen a little bit of just tongue-in-cheek type of stuff with LPs that you struggle to get a meeting with, and they're always saying to you, no, the next time you're coming by, let us know. And we've tried to unlock some of those, and we should use these opportunities to do that. I do think this virtual world makes our LP universe from a geographic point of view way more narrower and easier to access.
Paul?
Yeah, Helene, look, maybe just I'll echo Albert's comments on the macro. I think Africa, we've had difficulties with returns historically, but if you look at the data set at the moment, Africa's population is going to double through 2050. We are urbanizing at a rate of 25 million people a year. That's more than twice the rate of either India or China. Obviously, urbanized folk are a much more economically attractive opportunity set than people living rurally. And Africa sits with, broadly speaking, 30% of the mineral endowment on the planet. So we've got a demographic, argument that's very powerful. We've got a resource endowment that's exceptional. 60%, for instance, of uncultivated arable land on the planet is on the African continent. I don't know if you've ever seen that map of Africa, which superimposes, the US, Europe, Canada. They all fit onto Africa because of, the Mercator projection that we all grew up with at school, minimizes the size of Africa against the rest of the map because of the way it's spread out, taking a globe and making it flat. But Africa is actually it's 20% of the global landmass. So, and lastly, I think, on the governance theme, which is the big thing that possibly Africa's also dealt with historically. And we've got 54 different jurisdictions here, so governance is 54 different sets of issues. But if you look at work that Mo Ibrahim has done on governance, and he measures, I think, 90 odd different variables that sort of assess governance across each country in Africa. And if you look at the Mo Ibrahim Foundation, you look at the data that they're pulling out, you can see an inexorable trend line of improving governance broadly, over the long term. So I think, on that last metric, Africa is also moving forward immeasurably. And lastly, I think a very profound data point for Africa is the free trade agreement, which came into place last year, and creating a free trade area across the African continent, where I think it's 13 or 14% of trade in Africa is between countries in Africa. In Europe, that's north of 40%. So this issue of Africa learning to trade with itself and removing barriers and infrastructure, by the way, a big piece of infrastructure is creating the logistics for that to happen as well. So there really is an enormous opportunity set for Africa going forward. And if capital is appropriately deployed against that set of opportunities, then returns should come about. So in a sense, it's all up to us. On the African continent, if we get things right, this will be the place to be over the next 2 decades, definitively, because the hand we have, the opportunities we have in front of us is better than anybody else's. So it's ours to lose, as it were. Ours to lose.
Sure. Bit of performance anxiety there. Thank you very much, Paul. Thank you so much to the Africa Global Funds people for having us today on a very interesting subject. And thank you very much to participants. It's nice to see all of you from the before world in the now world. And hopefully soon we'll see you in person again. Cheers, guys. Cheers.
Thanks, everyone.
Thanks, Helene.